All right, Bryn. So Kramer says today we're in some bizarre halcyon period. And look, Pisani points out November to January is typically the S&P's best 3-month stretch. So you got history on your side. And by the way, the naysayers are getting tired. And I'm looking down again at Morgan Stanley's Mike Wilson. He's still negative, of course, but the recent trend is not his friend. OK, and he knows it. He knows it. He says today, bottom line, the fundamental picture for stocks is deteriorating as the Fed starts to tighten monetary policy. However, asset price, and I'm jumping around a little bit. However, asset prices are continuing to rise as retail investors keep plowing excess cash into these same investments. If our analysis is correct, we think that this bullish trend can continue into Thanksgiving, but not much longer. So what do you think?
Yeah, well, let's peel that back. So, first of all, we have to remember that the markets like to climb this wall of worry. And I do think that the corporate tax increases that seem to be off the table of moving that higher is incredibly positive, because that could have taken away about $10 of S&P earnings, next year. Now, talking about the Fed, so the Fed is expected to start their taper, announce the taper this week. We think they're going to do $15 billion a month. Per month. So that would say they would end that in June of 22. And so whereas Mike's talking about rate hikes, just to remember, Fed funds we're at 0 to 25. So if we got 2 Fed hikes at the end of 2022, that puts Fed funds at 75 basis points. So that is a wonderful environment when Fed funds are at 75 and you have the 10-year between, let's say, 150 and 2. That's actually a healthy environment. What's not healthy is staying at 0. And so I think that low rate environment that is here to stay, because remember, we have about 30 trillion we'll have 30 trillion of U.S. debt by the end of the year. As rates, they average 1%, that's $300 billion a year in interest that we will be paying. So the Fed needs to keep rates low. And I think that bodes well for technology and a bunch of other sectors. And so I think inflation will be higher. And, I want to close this thought on something that I heard Satya Nadella say the other day on his earnings call. And he said, digital technologies are a deflationary force in an inflationary economy. And so I just think where inflation will run higher over the next few years than it has, I still think technology is a great place to be. And I love how he summarized what Microsoft is doing. OK. Weiss,
Mr. Positive, you always bring good vibes to the show. Always, happy-go-lucky. How do you see it between now and the end of the year?
Well, good seeing you too, Scott.
Welcome, Weiss. I hope you had a nice weekend.
Me on today. I did. Thank you. Look here. Look, I think there's be some volatility. The trend of least resistance is higher. It's no surprise the Fed's going to announce a tapering tomorrow, and I think do it by the 15th. So that's pretty much priced in already. The market doesn't seem to care. They may talk about bringing interest rate increases, actual rate increases, forward. We'll get to see that. I think the market believes that'll happen also. I think it's a question of where you want to be. We are seeing some loosening in the supply chain. I got a copy of Pete's book in a few days instead of 3 weeks. That's a joke. I've never ordered his book. But I am getting goods that are coming in sooner rather than later. So, look, as the supply chain loosens, in my view, you're not going to want to be in the commodities, the hard commodities. You aren't going to be more in the consumer stocks. I've got representation there. And in the chips. We're hearing from Land Rover that the chip crisis is easing for them, and I think that's going to be consistent. Volkswagen said the fourth quarter, which we're in now, is going to be good. So to me, the market's going to be up. I don't see it moving up 10%. I think 5% would be a phenomenal move. But there's going to be volatility, so you have to be prepared for that. But seasonally, this is the time you want to be in the market.
Yeah, I mean, 5%, I think anybody would take 5% over the next
It'd be great.
Couple of months compared to what it looked like might happen, Steve. Not 3 weeks ago.
Yep.
Right?
That's the upside top, in my view. You're not going to see it run away. So when we talk about new highs, if you close a point up today versus yesterday or Friday, that's a new high. So you have to be careful of that. Again, it's the rotation that's going to happen underneath, and I do believe in some of the harder commodities, you're going to lose some steam because everybody's on board. Nobody thinks they're going down. And guess what? Commodities just impossible. It's always the marginal buyer or seller that gets you into trouble there.
Let me ask you this.
Be with the tried and true.